Hope Channel, changing lives.
Good evening and welcome to the Law Chambers, where legal matters are discussed from a Christian perspective. I am your usual hostess, Anita Delight, and today we're going to have a discussion on a quite technical topic. I'm calling it technical because there's no two ways. But the two people I have here with me today they are good at what they do. So I'm hoping that by the time we leave here tonight, you would have learned something. As I said, I hope you learned something, anything at all. It will be good enough for me. So we are live on Hope TV, on Multi TV, Facebook, Instagram, YouTube, live. You can watch us there. If you have any questions at all, you can send it there, or you can send it to 0559 680066. It seems that sometimes we leave the set and then we see some questions coming in. Please bring it on time so that we can answer it for you. So last week we discussed intellectual property, right? So we looked at trademarks and we looked at data protection. So say if you have a business and there's something unique about you, you have to protect it. And so I'm on sign there. So I promised you today we are going to discuss tax issues. So the whole of this season we are doing business in Ghana. We've been taking some general topics. So by now if you've not started a business, you know the kind of business you're interested in. Whether sole proprietorship or you're going to limited or unlimited, it's up to you. You know that you have to protect it. You know that you have to have certain documents in place in terms of your employees and the people you work with and work for, all that. By now you are getting somewhere, you are getting the idea. So now we're going to discuss tax issues, compliance with tax issues. So if you don't comply, what will happen to you? That's what we're going to discuss. And what I loved in law school was they drummed this thing in my head, that you can avoid tax, but you can't evade tax. That if you avoid tax, it's legal. But if you evade tax, it's illegal and you can be imprisoned. What does all that mean? We're going to discuss it today. So to do justice, allow me to use that word now. To do justice to this topic, I have two very, very, very eloquent persons here who would help me do that. So my first is Mr. Gilbert Yurinchi Ado. He's a senior manager, business tax and regulatory at Deloitte. So where do you can? Is it sachet? I'll ask him what it means because I've always seen. But Deloitte, we all know Deloitte, right? He's a senior manager with them. He has over 13 years of experience when it comes to taxation. He's a member of the ICAG, Institute of Chartered, so he's a chartered accountant. He's a member of the Chartered Institute of Taxation, or hobby. So when we talk about, and he also teaches at the Chartered Institute of Taxation. He's a lecturer there. You understand? So he works it and he teaches it. So by all means, Senti, or Deloitte, no senior manager there. Obe boy, and I get obe boy.
Oh, yeah, the mean boy,
But what's the word? Deloitte and what?
It's Deloitte and Touche.
Touche.
But currently we say Deloitte West Africa.
Deloitte West Africa.
Yes, because we have we have Deloitte West Africa and then Deloitte Africa because of the integration in order to harness the multiplicity of talents that we have in Africa. So that when we are to give advisory services, it becomes much more easier. I can sit here and then engage someone in Nigeria, engage someone in South Africa who has the required skill set in order for us to just give nothing but the best of advisory services.
So he's promising to give us the best. That is his promise, right?
Certainly, yeah, I mean, all
right. And I like to balance it out, right? Yeah. That's what I do. I like balancing things out. And so I have my lady with me, And she's lawyer Princess Akua Agbesi. And she's a lawyer with AB and David Africa. If you're a lawyer, by all means, you've heard of AB and David. If you're not a lawyer, by all means, you've heard of that law firm. It's one of the outstanding law firms we have in Ghana and Africa. Her areas are taxation, natural resource, ADR, but taxation is part of it. So say she's going to help us. She's an associate member of the Chartered Institute of Taxation Ghana, and she also serves as a committee member for the Chartered Institute of Arbitrators Ghana. As I said, she's a lawyer, and she's also a private tutor. When I was in law school, one of the courses I didn't like was legal accountancy. I didn't like it. But she helps students there get the grip of it. So if you're a student there, you're thinking of going there, say legal accountancy will be a problem for you. She's one of the people who can teach you. I wish I had someone like that then who would teach me. She helps with that. And how is it going? How is the teaching going there?
Oh, it's going well. I mean, so far we've been able to help a lot of students overcome their difficulty. I think the entire issue is, it's not because the students are not smart. Of course, there are a lot of students, they are very smart. So we just help with the communication gap and make sure that we're able to translate the legal accounting to them in a way that they will understand and pass. So it's been very good so far.
Because with lawyers, usually figures, you don't like figures.
Yes, yes.
And she's also the founder of ING Foundation. It's a non-profit project where young professionals provide career development guidance to BEC candidates in underprivileged schools in Ghana. I think that's one area I'm really interested in, helping underprivileged. So you take professionals there to go and mentor them to help them.
Yes.
Underprivileged. That's a good one.
Thank you.
A good one, Princess. That's a good one. So welcome, Princess and Gilbert. So let's dive in. Let's dive in. When we talk about taxation, what is it? Let me start from Princess. What is taxation?
I think taxes have been said to be our contribution to a civil society, and they are mandatory contributions that are imposed on individuals and corporations by a government entity. And the idea is that the government uses the funds that they receive through taxation to help us build a better society. So it funds infrastructure, it funds the budget, government spending. Yeah, so in Ghana, every penalty, levy, fine, interest that is imposed under a tax law or taken by the Commissioner General of the GRA under a tax law would be deemed as tax. Yeah.
So far as it's coming from GRA, it will be deemed to be tax.
It's not coming from GRA. GRA is the one doing the collection. It is imposed under a tax law. So what makes something tax is that it has to be imposed by Parliament under a law. We have to find it in a law that.
So when we go like GRA, GRA is not about GRA, it's about the law.
It's about the law. GRA is just.
GRA will not take.
It's just the agent.
So it's GRA. It's GRA will not take. Gilbert.
Yeah.
Yes.
So what are some of the taxes we have in Ghana, especially in relation to businesses?
Okay, so I would say that we have two systems of taxation. We would later break it down, but then broadly, we have the direct taxes and then the indirect taxes. So direct taxes basically speaks for itself. And as Princess did indicate, that government will need revenue, or whichever authority that is administering the affairs of a country would need revenue in order to develop the country. And certainly that will come from the amount that they are able to collect from the populace to be able to do that. So in basic terms, direct taxes are taxes that are borne by the earner of that particular income. Princess did touch on something very important, and I may be a bit technical. We have the Income Tax Act that drives direct taxes. And if you look at it strictly, it has the charging provisions as well as the machinery provisions. When we say machinery provisions, all that we are saying is that what must you do to determine the baseline in which the tax will be charged. So I earn salary by engaging in some form of what activities. A company also earns income by engaging in some form of what activities. So all that the state requires is that whatever you have earned, give us a portion, for a bit of it for societal development. So it is I, the earner of the income, that pays the tax. That's why I say direct taxes. Now, for indirect taxes, it is purely consumption driven. So if you don't consume, in principle, you don't pay the tax. Basic. If you don't consume, and you're a human being, once what is the reason for buying? It is to consume. So one example is value added tax. The principle is that, look, you want to change or convert a raw material into a finished goods. For what? For consumption. So at every stage there is some value addition. So it is that value addition that we seek to what? Levy taxes on. For whoever will benefit from that value addition to pay the tax. So that's how I say indirect. So let me use the salary. When I earn income, which is my salary, I pay taxes on it. I am paying. When I intend to use the salary to buy something, what I'm buying is a finished product which has gone through some value addition process. And the rule requires, and I don't want to say law, but the rule requires that we can also generate some form of taxes from there. So once I consume, I pay the tax. I'm not paying it because I've earned income. But I'm paying it because I want to consume. That is indirect tax.
Okay. Right. So it means that with businesses, depending on the kind of business you're looking at, they'll be dealing both. Because if they are buying, then it means indirectly they are.
Yes. So if you want to put it within the context of a business, why are you in business? I mean, who is in business not to make profit? Unless it's an NGO. The NGO my good sister here has. But principally, I'm in business to earn or to make some money. Mm-hmm. So whatever I make as a result of my business activity, I have to pay taxes on it. But how do I get the activity to operate? So if I'm doing buying and selling, I need to buy.
That's true.
Once I buy, I'll pay VAT. Mm-hmm. VAT is one of the forms of indirect taxes. I'll pay VAT. But I'm paying that VAT because at that point, I am seen as the consumer of that particular thing.
Okay. So now let's.
So to break it down.
Yes.
You are the producer of K-Pack. Mm-hmm. When I come to buy it from you, do you know what I'm going to use it for? I may use it, I may consume it, or I may sell. Mm-hmm. You get it? Mm-hmm. So when I buy it from you, the rule requires, and we'll go into the integrities of it later, the rule requires that you have to charge VAT. So you charge VAT, I pay. Then I take this. But when I take it and I consume it myself, the tax handle ends there. But if I decide to sell it to this person, then that means I'm not a final consumer. But I'll not sell it to at cost. I'll sell it with my profit element. So that's the value addition. So when I sell it, I'll make some income.
Yeah.
So assuming it is 100 cedis, I'll sell it at 120. She's buying it at 120. But she'll buy it at 120 plus a VAT component, which may push it to 130.
Yeah, and so and then when that happens, the profit you also make, you'll be paying tax on it.
Good. That's why I said the profit I make is devoid of the component she has to pay in addition to my charge. So let's make it basic.
Yes.
100 cedis. I bought it 100 cedis from you. If I'm into business, will I sell it at 100
So
cedis?
let's say 110.
So I'll sell it at 110. But the rule is that she's going to consume this, and I may have added some value. If I had not added any value, why would I sell it at 110?
Right? I need not add value. I want my profit. I'm doing buying and selling.
Why are you adding the profit? How did you establish the 10?
As in a 10.
Yes.
My transportation, my feeding, my...
So they all constitute value addition.
God. They're really paying.
Yeah.
Because something will trigger this to go up. So this is the cost, and you are adding some other incidental cost emanating from your business activity. So you are selling it at 110. The rule is that charge an indirect tax of, let's say, 10 cedis. So she's paying 120 other than 110. The additional 10 is not for you.
Yes.
It's for government.
Okay, so you are withholding it for the
So
government.
you are just an agent.
Okay.
So you collect it and pay
So
to
now I'm
government.
interested in the 10 profits I've made.
Good. So
What
that
happens to
10, that
money?
10 profit is what you pay what we call income tax on at a specific rate. Because you bought this at
Isn't
100.
it too much?
No. The reason why you
No,
think
because you are getting direct tax.
No.
The money, the profits I'm making, you're going to get money from
Who is paying the indirect tax?
It's on the same commodity.
No.
It's on the same commodity, but you are not consuming it. Who is paying the indirect tax? It is the one buying.
Final consumer.
So, in essence, assuming there wasn't any indirect tax, she still have bought it at 110.
Yes, but when I was buying it, I paid for that indirect.
That's why I
paid
said,
for it.
relax.
Now selling,
Yes.
someone will pay.
No.
Yeah.
That's why I said,
And course,
we'll go into the nitty-gritties.
I think I'm liking this already.
We'll go into the nitty-gritties of it.
Yeah.
But we have what we call the VAT accounting.
Okay.
So the VAT I paid when I bought it from you, the presumption is that I'm not the final consumer, but she is the final consumer. So an avenue has been created where you would take out what you have suffered from what you have collected from her. So you isolate the two. So assuming the 100 I bought from you, the real value is 90, but you charge VAT of 10. So it is 100 that came to me, but the real cost of this is 90. You have collected it and you've given it to government. It's not your money. Now, I will not have to charge or increase or incorporate my profit element on the 100. It should be on the 90.
Oh, okay.
Because the presumption is that I'm not the final consumer. So I'm going to sell. But you will not sell it at 90. You may sell it with your profit element. That's why it's a value addition. So the 10 is there. You sell it at what? Maybe 110. Don't forget that 110, it then means that your profit component on it is what? 20.
Okay.
I hope I'm not confusing our audience.
No, I think we are getting it.
Good. The
If you are
profit,
not getting it, please
the
send your
profit,
questions.
the
Okay.
profit component is on the 90. So it's 90 plus 20. The 10 is still there. So you sell it. But in selling it, you are saying that I'm going to add an additional 10 to the 110. So if we break it down, your cost is 90, your profit element is 20, and then the VAT that will be charged is 10. So in essence, he's going to pay how much? 120.
Yeah. Then it means
no, take your time.
No, I want to. It means a lot of businesses are doing it wrong, because I remember there's a lady who was selling, and then she realizes that her capital goes in terms of the payment.
Yes, you see, that's why we are having such a conversation. The challenge in our country is that a lot of people tend not to quantify the benefit that they will get in engaging experts. They rather look at the cost. Hey, or just 3,000, and anywhere do you? But the benefit thereon, because it's not physical for you to see, so you think you are incurring much. So this lady should engage. Maybe even she can even go to the Revenue Authority for some assistance, or get some experts to assist her.
Okay, so let me ask this question, Princess.
Yeah.
You see, let me try and understand it. So it means that if I am into business and I don't make profit, doesn't necessarily mean that then I'll not pay taxes?
Yes and no.
Okay.
So ordinarily, taxes are charged on your chargeable income, and that chargeable income comes from your assessable income. So we need to understand what assessable income is. Let me say this in tree. You know, the Bible says, and so good. So your assessable income is like adinina, which is all the money that comes to you, right? But the tax is not placed on all of that money. So out of the income you make, there are certain expenses that you make, and there are expenses that have been allowed by law for you to make, because we understand that these expenses are necessary in arriving at that income. So when you take those expenses out, then what is left becomes your chargeable income, which is the one that we have a right to charge, right? So the tax is charged on your chargeable income, and then you pay. So assuming by the time you finished your expenses, the legally allowed expenses, you had no money left, then ordinarily your chargeable income will be in the negative, and so the taxman should not have anything to tax, right? Now, I said yes and no because in one instance, maybe you think you are making a loss, but when we look at your accounts, the expenses that you are charging against your income are not right. So let me give an example.
Yes,
let's say a content creator. You want to start content creating business. So you buy an iPhone, I think the latest one is 15, and that costs over 20,000 cedis, right? Then you buy data, and you set up your ring light in your room, and then you start shooting your videos. In shooting your videos, you make 5,000 cedis, right? So when you do your accounting, you say that you bought data for 100 cedis, the iPhone for 20,000, and then you made 5,000. So to you, that 20,000 plus 100 against the 5,000, you've made a huge loss, right? But when the taxman comes, he won't agree with you, because the cost of the iPhone is a capital expenditure. That iPhone is going to last you, if you take good care of it, 5-10 years. So you can't take all of that 20,000 out of the 5,000 that you made. If you do that, you are cheating us. Do you get it? So you are supposed to spread that cost of the iPhone over time, and then small, you deduct it. So if we are to match your income against the direct expenses that allowed you to make that income, really we'll be looking at your revenue expenditure, which is the data that you bought. Okay, and so that data matched against the 5,000 cedis. Let's say if you paid for electricity in order for you to have that business. When we match it against the 5,000, obviously you've made profit.
But we'll be deducting a little bit of the money for the phone and for the ring light.
Exactly, because those are capital expenditures. They are expenditures whose benefits last more than a year. So if it's going to last more than a year, then you don't need to be in a hurry to take out all the expense this year. So in scenario 1, you made a loss, or you thought you made a loss. But when we looked at your books, you actually what? Made a profit. Scenario 2 is where you actually made a loss. This year, a new law was introduced, which is to the effect that if you make losses continuously for 5 years, the taxman is no longer happy with you, because we understand that there are businesses that consistently make loss. And if we are being honest, if you've been making losses for 5 years, then why are you... Exactly. So if you've been making loss for 5 years continuous, and you still want to be in business, then for you, we are changing the math. We are no more looking at profit, because for some businesses, he's going to make a lot of money, revenue. But when that money comes in, he'll tell you that because of his expenses, all the revenue goes away. So for such businesses, the law has introduced what we call minimum chargeable income, which is 5% of your turnover. What does this mean? This means that when you go to sell and you make money, we won't even begin to look at your expenses. All the money that came in, we'll take 5% of that.
That's suicidal.
Because you've been selling for 5 years and you say you've been making losses. So we'll take some of the money you get.
So it means you might even be going into my capital.
Yes, if that is how it ends up.
Not necessarily going into your capital. You see, one of the things we all have to know is that people are not honest to some extent, in as much as there are economic challenges. And we have some people who have found cosmetic ways of doing things. So, for instance, you've been making losses, but maybe the very premise that you are operating belongs to your brother, and you pay a huge rent to that person that you may be related to. You see, so although you have a huge rental charge, maybe that building could even belong to your wife or your husband.
Mean you shouldn't pay pay rent.
I'm coming. The rent should be reasonable. It should meet market values. I don't want to use certain terms, but in principle, it should be at arm's length.
It's understandable.
So there are some areas you go to rent a building, and you know on the average that they may charge 3,000 cedis, and it's something that is common, the same, maybe 2-bedroom house. Now, there are some areas in Accra, let's say people say, I don't know how true it is, but if you go and stay at Kaswa, maybe the rent it's a bit manageable, but you are not also considering other costs in terms of transportation, depending on where your work is and all. But then that is a general assumption. I've not tested that to know whether that is true. But granted that is the case, Kaswa, you are doing a business there. On the average, everybody is charging 200 cedis for a shop. But you alone, that same shop that you are doing that content, whatever, thing that example she cited, you are paying 5,000. Who are you paying the 5,000 to? Maybe when we go and verify, that shop is owned by your wife or your relative. So there could be that inclination to think that, look, you have found a way to benefit, whereas you don't pay taxes. You see, and that's why Princess said that. Yes, in tax, you say the chargeable income, if you want to look at it literally in terms of accounting, it's just your net profit. Your net profit before tax. Accounting. You can say, you show unfaso. Unfaso awenya. Ebi unfaso awenya no 100 cedis. Then so once keke say wonsoro akeke sɛ obenya mfaso wobɛyɛ bibi enti no waboka ɛna wode ayɛ bibi na wanya mfaso enti yɛnte wo ka ne mfim te bia ka na boy ne 80 a yɛte 100 no mu a mfaso no ɛyɛ den 10 enka obiara di no kware anka ɛbɛka sɛ okay fine enka 10 no should be the baseline for imputing the tax, because she alluded to the fact that that's why I say charging provisions. As I say, Emrano eshe bibi, emma bibi some power to be able to impose the tax. In Emrano it's okay we a 10, but I bet you 25% pay of the 10 as revenue to the state. But be as 80 no. As I say, if you be matching concept in accounting, match your cost against your revenue. To your purchase, I say a related cost. Enti say, o say, oh yeah, Juma, o ton adie. Na, what you be? Edi akutia ube school fees. Eno nye business cost. So obe tuya ube school fees ah. As I say, adwuma no mu no utua ho na se utua ho wie a wayi emu bi e de amiti wo domestic expenses.
Yeah.
Na ye kohwe 80 no mu na se domestic expenses bi ewo mu a wetua school fees, efie light bill, enye adwuma no mu light bill, efie water bill, na odi na afra emremu no ye besisim ye friend no non-allowable expenditure and a non-deductible. Jebesi sims okay yenhwe 80 no ni sa ayi ka aisa kana wo se waboni na school fees yin film because I know there say nke fi bottom enye business na wo ba wo na wa wo ba
Yeah.
what you say nti yen no ni enfe no nto nchen efie na otimu no enye ho na wo ye business no say ho na wo ye business to kra na ye wo kwan a ye be chim ni mu say wo ye business de e na wo ye efie de nti yes efie bi amame aba wa ma no 1 Ghana na wo de account ada wo ma me no de adwuma no be ma wo eno e say efie wo salary nti yes sini na efie me ka say oh okay nke ehwe no hata sa nka profit no nke ese nke 20 because u kan 80 uti 100 mo e ka 20 ese nke 20 ba ehwe mu no u kan kasa u boy 50 inti emra kwa mu no se be calculate tax na
Below 50.
it should be on the 50 and not the 20. Sana mra no ya hihye no bampempi no small business ni omo she business ase no esan say bebre na mfa proper accounting systems engu akwam ne ka say proper accounting system a bia nye say bi akọ school akoya accounting chi o notebook a ubetumi atworo oh me to say so niama na wo ton a wo ko mokola na akoto niama no ka you swai o fa trotro o ye se bia o ton suo nom ye ubetumi po.
So all things really cool. You have a notebook down. You have all these, and then you write everything down. All your expenses.
All expenses. And our income. Oh, because say akola.
And I think our grandmothers and our mothers used to be good at that. They have a whole book.
Yes. So akola. Sebi on sorry akeke no wenyi. Enti business na wa sha ase no. Ayesa akola. Uye nyomani ya na ode mpaebo ma akola no entity pa onyi a ode ene pa edi saa na business so tie nti se ode niama papa gu akwan mu a obenya challenges de na o record bibia ti by the time a oni beba ho so no na abeye business kese en ho no na ebia ene obehia external support a we akofa accountant akofa se banfiti ase no wan kasa na ese o make sure say sa niama we na no uye no yi ko eno ne ye be gina so de aye tax no
So in a nutshell, what we are saying is that have everything written down. You understand? Expenses and your income, have it written down. There are some expenses, it's not going to be allowed. You can't be doing your business and then you see, I paid my children's school fees. I rented the house for my mother. I gave my father 500. What has that got to do with the business? That's not expenses deriving from the business. So it's not expenses you can take out from. But expenses that you make in respect to the business itself, you take it out, and what's left is your profits, so to say. And that's how, and that's the amount you're going to pay the taxes on. So it's possible that you make a loss, yes. But as Princess said, if it's 5 years continuous, that means all things being equal. They're even going to take the money from the money itself. It's not easy. So you are doing business and you have to really think about putting in place the right structures. Because if you don't, you'll be paying more than you should. Or illegally, you'll be paying less than you should. Let's go for the short commercial break. We'll be right back.
Maria Tasa Baza Birim Macarono Arada Jeronia Casan Mania Minia Wamica Jeronia Casan Maya Jamai Consano Macosumadino Depia Amidia time to Oriano Yantem Masafumo Amidia time to Oriano Yantem Wafia Amidia time to Oriano
Praise Quarters showing this and every Friday at 6 p.m. only on Hope Channel Ghana, your preferred Christian TV station.
As a small business owner, Mitaisha Business Forum, our Hope Channel, it really helps me with my business.
Don't let your priorities be because obi binti. Also, share some wide. Why one kasa sawasa. So jani niya obiani.
Okay.
Obiani need so that ungo fa a problem in my house.
In the first place, business a risk.
Okay.
It's just all about risk. Now, pursue your business so. Now you need you should be a risk taker.
Okay.
I would recommend it to you to mess rest also beshebi.
Welcome back. And we're having a discussion yet. We are still laughing from it. So now we don't have much time, so let me delve in. So when we talk about threshold, usually there's companies, Princess, is there a threshold that a company may not be allowed to pay taxes? Do we have something like that? If we do, how does it work? So we'll be displaying something on the screen, and I think Princess will be taking us through it.
Okay, so quickly before we get to the threshold, every business type has the tax structure under which it operates, right? And in Ghana, we have something we call the graduated scale. And the graduated scale feeds into the idea of progressive tax. The concept is that the higher you earn, the more taxes you pay, because that is deemed as fair. After all, the person making more money should pay more taxes. So the one who makes less money pays less taxes. That's the graduated scale. So for individuals and sole proprietorships, I believe you've discussed business types on your previous episodes.
We have.
Yes. So sole proprietorships are deemed as one and the same with the business under which they are trading. So sole proprietorships use the graduated scale.
Okay.
Partnerships also use the graduated scale, because even though partnerships are deemed separate from the partners, which is the owners, when it comes to tax, we say that the partnership entity is transparent. What does that mean? If we say something is transparent, it means you can see through, right? Yes. So when it comes to partnerships, you look at the entity, you see through, and then you tax the partners behind it. So you also use the graduated scale, so as if they are individuals. But when it comes to companies, companies do not use the graduated scale. They use flat rates. So depending on the industry in which you are located, the ordinary company pays 25%. But we have companies in, let's say, mining and petroleum, and they pay 35%. You have companies in the hotel industry, they pay 22%. And if your company is involved in the export of non-traditional goods, you pay 8%. So it depends. Now, back to the question of thresholds.
Yes, and we are displaying it.
Yes, so for individuals, sole proprietorships and partnerships that use the graduated scale, there is a limit or there is a band, right? At this band, so on the screen we have the monthly table. What this means is that for your first, this table means whatever figure here you are earning monthly, you pay the corresponding tax rate.
Okay.
So for a person who earns 402 cedis below, so from 0 Ghana cedis up to 402 cedis, that person is required to pay tax at a rate of 0, which means you don't pay tax.
Okay.
So assuming your salary is 400 cedis the whole year, you don't earn any other money apart from your salary. That is very important, because maybe your salary is 400, but back movement. Yes. So if you are earning below 400 cedis a month, 402 a month for the whole year, it means that you don't pay tax. So when he moves to, please go to the annual table. So for someone who earns annually 4,824 cedis, such a person is not liable to pay tax. Remember, individuals, sole proprietorships, partnerships. However, if you have a company and your company makes the same amount, your company will have to pay tax.
That percentage.
At the required flat rate, because companies are separate legal entities.
They are different from the individual.
Exactly.
So they can sue and be sued.
Exactly.
And I say very so you see why you should be doing sole proprietorship?
Yes.
You see,
yes.
We are going back there.
So that is an advantage. So you have a threshold. Okay. And just because we are on your show, I'll throw in something for the sole for the sole proprietor. So there's a new tax that was introduced this year as well, the Growth and Sustainability Levy. And entities in Ghana have been grouped. So we have the banks who are supposed to pay 5% on their profits before tax, which means all our tax expenditure as we know it is going to go up. Yes. So for the first group, banks, insurance companies, and the likes, they are paying 5%. So they'll pay this 5% before they come and pay their actual income tax rate.
Wow.
Yes. Now, for mining and petroleum companies, they will pay 1% on their gross production. For every other company or every other entity, okay, and this is important, for every other entity, they will pay 2.5. But the GRA is yet to release any practice notes on this, so we don't know the further details yet.
So you mean to tell me I'll pay this tax before the real tax will be paid?
Exactly. But
so on the gross?
Yes. No, not on the gross. So when you arrive at your net profit, right, before you pay the actual tax, you pay Growth and Sustainability Levy. After paying that, because the idea is to help the economy. And then after paying that, you add it. But the reason why I actually brought it in was that this levy so far is for entities, and sole proprietorships are not deemed as entities.
Partnerships?
Because partnerships are entities, but sole proprietorships are not entities. So if you're in a sole proprietorship, one, your advantage, you get to have this threshold. Partnerships also enjoy this threshold. But because you are encouraging your listeners to do sole proprietorships, another advantage in there is that for now, they don't seem to be in the net of the Growth and Sustainability Levy.
So all we are saying is that until you gain that feat, until you know what you are really doing, starts from somewhere, and that somewhere could be sole proprietorship.
Yes.
Don't just move into the company, because as we said, registration, You can't come from company and come to sole. But when you start from sole, you can go up to company.
Exactly.
Like, who started business? I look at all these things. So how do I cut down on my tax? How do what is avoiding tax and evading tax? Let's discuss that first. And then tell me how to avoid it, because I really need to avoid it.
Okay, I mean, this has always been an interesting question. And I have always advised that the best form of tax avoidance and not evasion is to
What's the difference
obey.
first?
Is to obey. I'll come to that. Is to obey the rules. Obey the rules.
The
So
rules.
we'll get there. So tax avoidance is principally using or identifying loopholes in the tax law which are legitimate in order to get tax savings. So I use loophole, but it may not necessarily be a loophole. For instance, if you're into manufacturing, you have what we call location incentive. So depending on the location in which you are operating, you have a tax rebate. So assuming you are in Accra, Tema, the tax rate you pay as a corporate entity will be 25%. But if you are in other areas other than Accra and Tema, you are going to pay 18.75%.
Oh, okay.
Which is driven by the location you find yourself in. One other thing she made mention of when she was giving her submission was that, said hotel, you pay 22% corporate income tax. It is entity driven and not location driven. If you are into the hotel business, you are not going to pay corporate tax at 25%, but you pay corporate tax at what, 22%. I mean, these are what we would say loopholes, but they may not necessarily be loopholes. So that is what drives tax avoidance. Using the tax law in such a way to derive tax savings.
So now let me be practical. The common business, sole proprietor, business owner in, let's say, Medina, how does that person avoid tax?
Good.
Practical.
I don't want you to use how does that person avoid
I
tax.
didn't say evade. Avoiding is legal.
I'm not comfortable.
Is it-
You're not comfortable.
Yes.
Yeah,
When
yeah,
he's
yeah,
done,
if you hold.
when he's done, I'll explain why
Is
I'm
it-
not comfortable.
You
Alright.
see, the setting we find ourselves in, people may misconstrue
Yeah.
it. Now, evasion is you deliberately avoiding to pay tax. That one is illegal.
And you can be imprisoned. Yeah.
Yes, swawa. Me amebua me edwa kotum. It, you know, that one is out.
Yes.
So, for instance, you are sole proprietor in Medina.
Yes.
She has already indicated that for sole proprietors, you pay taxes based on what? The graduated scale. So how do I maximize my tax savings as a sole proprietor?
So I do
One.
not earn more than 4.
One, having proper accounting systems. That's where I'll start from. I won't even worry myself with law. Having proper accounting systems of recording your expenditure right. She made mention of capital allowance. There's one other thing that are also for young young entrepreneurs.
Yeah.
They have tax rebates.
For young entrepreneurs?
Yes.
Oh, okay.
We-
The younger, do you have an
Age
age
30.
limit?
Up to age
35.
35.
Okay.
You have a tax rebate. And
The rebate, is it
if-
full or is it
no, you have a
partial?
tax rebate, and that is driven by the kind of activity you are in.
Okay.
We can go into that. Maybe we
Okay.
can look at that later.
But you have an idea if you're under 35 year an entrepreneur and you know that
Yes.
there's something like that for you.
Exactly. So you can also exploit such an option, and that is within the remit of the law. Capital allowance is also there. Why do we say capital allowance? You buy assets. All that the law is saying is that, look, I know you have invested much, so I'll give you some respite. I'll give you some relief in order for you to be able to maximize your tax savings. But accounting for that in itself is a problem for you, the sole proprietor. So she said you have classified it as a revenue expenditure
Instead of capital.
instead of, in order for you to quantify, although the benefit is target, it is still a benefit. It's a way to reduce your tax base.
That's interesting. You see, and we always come back here that, you see, sometimes it's expensive. You think it's expensive to get an expert to do your work for you, but it's more expensive when you don't get the expert. You see. So as we are moving on, yeah, you might be starting small. You don't have that much money, but you have friends. Leverage on relationship, network. We said that before. Network and talk to friends who can help for now, because it seems as if you don't have the knowledge, you might be doing a lot of things already. Princess, you wanted to add something to it?
Yes, so I'm not comfortable when you keep asking how to avoid
because
tax.
me in my law class, I was told it's okay to avoid tax,
Yes.
but you can't evade tax. So I mean, I want to avoid now.
But you see, even that statement is no longer absolute, because the law, we have progressed, and initially we realized that yes, tax evasion, everybody said evasion is illegal, fraudulent, but avoidance, when the law hates aggressive tax avoidance. What do I mean by aggressive tax avoidance? So your whole concept is to come to put together all the good things and the benefits in the law just to derive that benefit. The law hates
something
that.
Wrong to be smart?
You see, it's Kwekwa Nancy. It's a bit, you know. So the law doesn't like that. But here's what happens, right? The Commissioner General, the GRA, has been given the power to disregard an arrangement or a transaction whose sole benefit is to avoid tax. So if you locate your business in a certain place, because I want to work out of Nsawam. Nsawam is not a regional capital, so it's a manufacturing business. You are getting 12.5%. That is the law benefiting you greatly, right? But if on paper you are telling us you are at Nsawam, but in reality you are not in Nsawam, so you just want to fool us, or even creating a transaction in a way, cooking your books. Okay, I'll always make sure my book is 400, 401. Aggressively. The Commissioner General has the power to disregard it.
I get you.
Sometimes you get accountants whom you tell, oh no, with the increasing expenses, no, now you enter tax. So the thing is that when there's a tax audit, that time you have paid the accountant and he's gone. And the rules of engagement are not such that when you are having challenges, you hold the accountant liable. For all you know, you even appeal to his conscience for that accountant to do that.
But what if I don't, the accountant advised me and I did what I did?
Great. So that's why I said the rules of engagement. And most of the times you don't sign engagement, so that you can then put clauses in there that could hold the accountant liable. But I did indicate that the best form of tax planning or managing your taxes sits on 3 pillars. Reporting requirement. Now the reporting will look at how you are doing your accounting. The same tax law, when you look at the Revenue Administration Act, and compels us to keep adequate records. It's a legal requirement, and it has its related sanctions. So the expectation is that you report right. And once you are reporting right, the expectation is that you pay right and you also file on time. The beauty of these 3 pillars is that all of them have sanctions. If you don't report rightly, you may either pay fines penalties, or find yourself in a court, which will later send you to any of the prisons in Ghana. If you don't file on time, you pay what we call penalties.
Okay.
There's nothing like fines or nothing, penalties.
Penalty
And it's
for-
500 cedis on the spot and 10 cedis on any day that
Default.
the default remains outstanding.
Oh, okay.
So you are paying what? Penalty. So you have to file. And there are timelines in law. For your withholding, you have to file on the 15th of the subsequent month. The expectation is that by that time, you should file. Whether you have engaged in any activities or not, you have to file. Because it's a form of giving what? Information to the revenue authority as to how your business activity is faring. And your payment requirement, and that is where the interest component comes in. Most at times, people misconstrue penalty payment with interest. The interest is the opportunity cost for holding on to government money for that period of time. So you have to pay 1 Ghana cedi and you decide not to pay. So there are mechanisms to establish the interest, and it has a compounding effect.
Yeah.
Charlie, if you don't pay taxes,
So I always tell
Yeah,
people
no.
that the best form of tax planning and tax avoidance is to make sure that these 3 pillars,
you adhere to
you
them.
adhere to them.
So let me ask the final question. My time is up.
Yeah.
Princess, so let's say I'm a foreigner.
Yeah.
I want to come and do business in Ghana. Any tax rebates for me?
Yes. So in Ghana, there are a lot of opportunities for foreign businesses that come to Ghana to enjoy a good business environment. We have the Ghana Investment Promotion Center, GIPC, and you are required to register with GIPC. If you're a foreign business coming to Ghana, you have to meet your minimum capital requirements. Once you meet the minimum capital requirements and you establish, GIPC would help you to enjoy some of the tax benefits that already exist in. If you are importing certain unique machinery, they can assist you to procure tax exemption for that. But beyond that, we also have the free zones, which is an area that has been declared. And if you're a free zone enterprise, what happens is you enjoy your business profits without tax for the first 10 years on the major condition that after procuring the license to be a free zone enterprise, you have to export 70% of the goods or services that you are producing or you're offering. So as a foreign company, if you come to Ghana as a free zone enterprise and you get your license and you export 70% of what you produce for the first 10 years, 0 tax.
Do we have something like that for the Ghanaian companies?
Yes.
The thing is, one thing that you'd have to know is there's a reason for the free zones. And it is to also help the country balance its terms of trade.
True.
Yeah.
You understand me? Because the more you import, you suppress your cedis because you are going to pay in dollars. You have to change cedi. That's why we're having problems with our cedis.
I agree, but
So the
if there's a
expectation is
company
that-
in Ghana, a Ghanaian company
Yes,
that also
a
does the
Ghanaian-
same thing,
Yes,
they also
you
get
can
tax
also
rebate.
procure a free zone
You
license
can
and enjoy it.
procure
Absolutely.
that.
Okay.
Absolutely.
But the cardinal thing is that it should be for export.
Yes.
And that's where sometimes people get it twisted. If you make a sale to the local market, the parameters will change.
Yes, but even that one, you're allowed to sell 30% of what you produce to the local market. But if you intend to sell everything to the Ghanaian market, then you can't enjoy the benefits under the free zones. So beyond the tax holiday, which you get for the first 10 years, even after that, for your exports, you enjoy a reduced rate of 15%. Your shareholders, the dividend that is sent to them is
tax-free.
Tax-free. So if you're a foreign company, you establish a company in Ghana that exports the goods, the money that comes back to you, the shareholder or the parent company, is tax-free. And that tax would have been 8%. But because it's under the free zones, you don't get to pay any tax on that.
That's interesting.
All importations and exportations in and out of the free zones is tax-free.
And you can be a Ghanaian and still be in a foreign business.
Yes.
Next week, we'll be talking about foreign businesses.
Yeah.
All right. So if you're a Ghanaian, you can go into foreign business. So next week, don't forget, we'll be talking about it. So in a minute and 5 seconds, your final words. My time is up, actually.
Yeah.
Yes, so just respect the 3 cardinal pillars I have shared. Your filing requirement, make sure you file and you file on time. Pay the taxes right. If it's 1 cedi, pay. And also report right. If you have challenges, engage the revenue authority.
Ghana Revenue.
And you can have a conversation around even they helping you to get a payment schedule in order to manage the challenges that could come with you not doing the right thing.
Thank you. President.
I know we've discussed a lot of taxes here, and it may seem scary to the ordinary businessman, but believe me, there are a lot of benefits and a lot of advantages and provisions in the law that we can take advantage of to make sure that businesses are thriving. And so I believe it's very important to always reach out to experts and make sure that you are getting the best advice so that your projects can succeed in Ghana and even Africa.
Okay, so a quick one. So experts, I've come to you, my business. I want you to help me with my tax. How much will you charge?
There's no flat
rate.
There's no flat. There's no flat rate.
What is that you don't
There's no flat rate, but it will definitely be in your best interests.
All right. So my sign language interpreter is Tanya Meche, and yes, next week we'll be talking about foreigners. A Ghanaian, you can be a foreigner in terms of businesses. How do you go about that? Next week we'll be discussing that. Please take care, and until next week, adieu.